Hi, this is the second complete comprehensive example with adjustment of capital where we are dealing with the first method of adjustment of capital. Adjustment of the old partner's capital accounts on the basis of the new or incoming partner's capital. So this example sum will deal with this first method of adjustment of capital. Example sum. X and Y are partners sharing profits in the ratio of 2:1. Their balance sheet as at 31st March 2019 was. To the left of the screen we have the balance sheet given. To the right, additional information. They admit Z into partnership on 1st April 2019 on the following terms. Z brings in rupees 40,000 as his capital and he is given 1/4 share in profits. Point B, Z brings in rupees 15,000 for goodwill, half of which is withdrawn by the old partners. Point C, investments are valued at rupees 10,000. X takes over the investments at this value. Point D, printer is to be depreciated by 20% and fixed assets by 10%. Point E, an unrecorded stock on 31st March 2019 is rupees 1,000. Point F, by bringing in or withdrawing cash, the capitals of X and Y are to be made proportionate to that of Z on their profit sharing basis. We are asked to prepare revaluation account, partners' capital accounts, and the balance sheet of the new firm. So here in point F, it says by bringing in or withdrawing cash, the capitals of X and Y are to be made proportionate to that of Z on their profit sharing basis. So we can understand that it's the first method of adjustment of capital where the old partner's capitals, that is X and Y's capitals, are going to be adjusted based on the incoming partner Z's capital. And the mode of adjusting this is by bringing in or withdrawing cash. So we will have to adjust the accounts by using bank account. As far as the goodwill treatment is concerned, Z is bringing in his share of goodwill rupees 15,000. Half of this is withdrawn by the old partners X and Y. So we'll begin with the revaluation account, followed by the partners' capital accounts and then the balance sheet. Solution. Revaluation account. Left side debit side and right side credit side. Particulars. Rupees. Particulars. Rupees. Point A is about the capital which is brought in by Z. Point B is about the premium for goodwill. Point C says investments are valued at rupees 10,000. X takes over the investments at this value. So we have to increase the value of investments from 8,000 rupees at what value it appears in the balance sheet to rupees 10,000. So by investments account, ₹2,000. Point D, printer is to be depreciated by 20%. So to printer account, 20% of 5,000 rupees is 1,000 rupees. Fixed assets is to be depreciated by 10%. So to fixed assets account, 10% of 1,37,000, 13,700 rupees. Point E, an unrecorded stock on 31st March 2019 is rupees 1,000. So by stock account, 1,000 rupees. Point F is about the adjustment of capitals. So we have the total of the credit side coming to 3,000 rupees and the total of the debit side coming to 14,700 rupees. The greater total on both sides, 14,700 rupees. We have a loss by loss on revaluation. Transferred to partners' capital accounts. X and Y. Total loss rupees 14,700 minus 3,000, which comes up to rupees 11,700. 11,700 to be distributed between X and Y in their old profit sharing ratio, which is 2:1. So against Y we have 3,900 rupees. And against X we have 7,800 rupees. So this is the revaluation account that is prepared for this sum. Next, let's prepare the partners' capital accounts. Partners capital accounts. Left side debit side, right side credit side. Particulars. Partner X, partner Y and partner Z. And on the credit side again, particulars, partner X, partner Y and partner Z. We will begin by bringing down the balance of the capital accounts. By balance brought down, excess capital balance is 75,000 rupees. And Y's balance of capital is 62,000 rupees. As per point A, Z brings in rupees 40,000 as his capital. So by bank account, ₹40,000 against Z. We have a loss on revaluation. As per the revaluation account, the loss is 7,800 for X and 3,900 for Y. Next we'll deal with the reserves. There's a general reserve. By general reserve, rupees 18,000 to be distributed in OPSR 2:1. So 12,000 against X and 6,000 against partner Y. Next we'll deal with the premium for goodwill. There is no mention about the sacrifice or the sacrificing ratio or the NPSR. So the sacrificing ratio is equal to the old ratio, which is equal to 2:1. And point B says Z is bringing in rupees 15,000 for goodwill. So by premium for goodwill, $15,000 to be distributed in sacrificing ratio 2:1, 10,000 for X and 5,000 rupees against Y. Also says that half of the premium for goodwill is withdrawn by the old partners. So to bank account, 5,000 against X and rupees 2,500 against partner Y. We need to deal with the point C, which says investments are valued at rupees 10,000 and X takes over the investments at this value. So for taking over the investments, the journal entry, investments has a debit balance because it's an asset, and when X takes it over, you need to credit the investments account and debit X's account. So the journal entry is X capital account to investments account. So to investments account, 10,000 taken over by partner X. All the entries are done. We need to make the adjustment of capitals. We will put the partners' capital accounts on the top half of the screen. And we will move to the working notes at the bottom half of the screen. Working note 1 is for the adjustment of capital. The step 1, total capital of the new firm. We need to take the incoming partner's capital rupees 40,000 and multiply it with the reciprocal of Z share in profits. Z share in profits was given in the problem as 1 divided by 4. So we will multiply by 4 divided by 1. So we have the total capital of the new firm as rupees 1,60,000. Step 2, calculate new profit sharing ratio. So we need to calculate the new profit sharing ratio. It's not given in the sum. We have that the old profit sharing ratio between X and Y is given as 2:1 and Z share is equal to 1 divided by 4. There is no mention of any sacrificing ratio, etc. So the sacrifice ratio between X and Y is equal to the old ratio between them, which is 2:1. So then we can apply the shortcut method. Where the new share is equal to remaining share multiplied by the old share. Z share is equal to 1 divided by 4. Therefore, the remaining share is equal to 1 minus 1 divided by 4, or in other words 3 divided by 4. New share of partner X is equal to the remaining share 3 divided by 4 multiplied by old share of X, which is 2 divided by 3, comes up to 2 divided by 4. The new share of partner Y is equal to the remaining share 3 divided by 4 multiplied by Y's old share, which is 1 divided by 3, is equal to 1 divided by 4. Hence, the new profit sharing ratio between X, Y and Z is equal to 2 divided by 4 is to 1 divided by 4 is to 1 divided by 4, or in other words 2 is to 1 is to 1. Step 3 is to calculate the new capitals of the partners. We need to take the answer of step 1, which is rupees 1,60,000 here, and divide it in the NPSR of 2 is to 1 is to 1. So rupees 1,60,000 divided in 2 is to 1 is to 1. So for X we get rupees 80,000. For Y we get rupees 40,000, and Z rupees 40,000. Step 4, calculate adjusted capital of partners. That is the capitals of the partners after all adjustments have been made, which is the total of the credit side minus the debit side for each of the partners. So in the case of X we have rupees 97,000 which is the total of the credit side minus 22,800 which is the total of the debit side. So this comes up to rupees 74,200 rupees. In the case of Y, the total of the credit side 73,000 rupees minus the total of the debit side 6,400 rupees, which comes up to rupees 66,600. And as for Z, it remains as rupees 40,000. The final step 5 is to compare adjusted capital with the new capital. In the case of X, adjusted capital is 74,200, whereas the new capital is 80,000 rupees. So X needs to bring in cash. So the journal entry is bank account debit to excess capital account for the amount of the difference, which is 5,800 rupees. Now in the case of Y, the adjusted capital is 66,600 rupees and the new capital is rupees 40,000. So Y has to withdraw cash. So the journal entry is Y's capital account debit to bank account 26,600, the difference amount. So we'll insert these two entries in the partners' capital accounts. In the case of X, it's by bank account 5,800 rupees. And in the case of partner Y, it is to bank account 26,600 rupees. Finally, we'll insert the new capitals of the partners to balance carried down. New capitals 80,000 for X, 40,000 for Y and rupees 40,000 for Z. So it's 80,000 rupees, 40,000 rupees and 40,000 rupees for Z. If both sides tally, then we know our arithmetic is right. So let's check whether it's tally. In the case of X, total of the credit side 1,02,800. Total of the debit side is also 1,02,800. In the case of Y, total of the credit side 73,000. And the case of Y, the total of the debit side is also 73,000. And in the case of Z, both sides total to rupees 40,000. So the partners account, capital accounts, that's prepared by us in the top half of the screen. Next, we will prepare the balance sheet of the firm. Balance sheet as at 1st April 2019. Left side liabilities, rupees. Right side assets, rupees. We'll begin with the liability side items. The first item, sundry creditors. No change in value, 25,000 rupees. The general reserve has been distributed. It will not appear in the reconstituted balance sheet again. We'll insert the capital accounts of the partners. We have X, Y and Z. The balance carried down of the partners' capital accounts. It's 80,000 in the case of X. 40,000 in the case of Y and 40,000 rupees in the case of Z. So it's 1,60,000 rupees, the total of the capitals. We'll go on to the asset side. We'll begin with the bank balance. So So we have the opening balance as rupees 5,000. We add the capital which is brought in by the incoming partner Z, which is rupees 40,000. Z also brings in rupees 15,000 as premium for goodwill. So plus 15,000. The sacrificing partners withdraw half of the premium for goodwill. So minus half of 15,000, which is 7,500 rupees. And also, while making the adjustments for the capitals in the partners' capital accounts, we found that X is bringing in cash of 5,800 rupees and Y is withdrawing 26,600 rupees. The total of the adds 65,800 rupees and the total of the minuses 34,100 rupees. So we have 31,700 as the bank balance. We'll complete the other items on the asset side. Debtors, there is no change in the value, 15,000 rupees. Stock, we need to add the unrecorded stock of rupees 1,000 to the existing balance. So now it's 11,000 rupees. The investments has been taken over by partner X. Printer, depreciated by 20% or rupees 1,000. So now it's 4,000 rupees. And the fixed assets was depreciated by 10%, which was 13,700. Which comes up to 1,23,300 rupees. Let's check the total of the balance sheet. Total of the liability side is 1,85,000 rupees. Total of the asset side is also rupees 1,85,000. So this is a balance sheet. I'll remove the split and we can view all the accounts together. So we began by preparing the revaluation account. Followed by the partners' capital accounts. Followed by the balance sheet. And the working notes were prepared after the balance sheet.